All right, we're live. Hello, hello. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream where we talk about personal finance, investing, giving you the insights, giving you the perspectives that you need to make the right moves and to hopefully avoid the right moves. Or I just messed that up so bad. To make the right moves, to make the right moves and to avoid making the wrong moves. I just got off like a Zoom and I'm like, ugh. Anyway, if you were on the Zoom and you're watching me now, thank you so much. I really appreciate it. For those of you who are watching me now who said you're going to be on the Zoom, I would like to say that to you. And I will make a recording of the Zoom and condense it to the important points. So the point of that was that my firm is client first strategy. As the complexities of my businesses have grown, of the industry have grown, it made sense for me to partner with a firm that believes in technology and client service as much as I do. So therefore, we partner up. We have better service, better technology, better scale, better back office abilities, better everything. And then we use that to service our clients better and to make sure we're keeping up with all the complexities of the industry, such as compliance, which is a really big one. And I think that is probably the biggest destroyer of businesses today in my industry. It's an important piece, don't get me wrong, because there's still a lot of bad people out there. So unfortunately, the compliance grows to accommodate the rotten apples, right? Even though we say that's not fair, but that's the way life is. Anyway, so that is something that's really good, and it frees up my time to do more client-facing things. And I wanted my clients to know that there are people behind me who will be watching the store. So if I'm out, I'm not talking out for like an afternoon or a few days on vacation. I'm talking like if I'm out because I have a short-term disability or something, there is somebody minding the store or somebody they could talk to, somebody who they could get on the phone immediately and who's familiar with their financial situation. That's really what I want my clients to get out of that. I think the technology and everything, I don't think the clients really care so much about the technology as they really care about how is it going to help them reach their goals or help me service their accounts better, more efficiently. So that's where we are. Rita is out there. Enjoyed the call today. Hey Rita, thank you so much for being on. I really appreciate it. Just so you know, I lost my internet service at like 3:58 p.m. The Zoom was at 4 o'clock. So I'm like, for like 3 minutes, I'm under my desk. I'm unplugging the router. I'm taking the power source out of the cable modem. So I was going to do this on my cell phone, which I didn't really want to. And then the internet service came back on at like 4:03. So it was just like a Harry moment for a second. I was getting sweaty. I was under my desk. I was like in an uncomfortable position. So we got it going. All right. Anyway, the big story of the day is inflation. I mean, that's the only story of the day. So we're going to talk about that. Let me roll a quick intro, and then we're going to get into why I think it's such a backward-looking number already. Here we go. All right, thank you very much. We're just getting started. I'm Mitch Goldberg. We're just going to do a quick summary of the day. It's all about the inflation figures. They came out this morning. CPI, Consumer Price Index, was expected to be up 8.8% year over year. It came in at about 9.2%. And, when people saw that nine handle, it was pretty freaky for a little bit. The Dow was down as much as 400 some odd points, 448 to be exact, at its worst point of the day. Markets did recover off their lows pretty solidly. I mean, it was a down day today, but not a disaster. But what does it tell you? Okay. It tells you a couple of things. First, it tells you that the next Fed meeting in later this month, next week, the Fed is expected now to raise short-term rates, the Fed funds rate, by 75 basis points, or 0.75%. So we'll get it up to about 2.5% short-term rates. So that's one thing. So the Fed sees that higher than expected inflation number as permission to raise rates. They're trying to claim back credibility. That's a whole other story. But a lot of the inflation today is blamed on, the Fed gets a lot of blame, and rightly so. They were creating too much stimulus too much too quickly. They didn't back off soon enough. But the Fed did say we'd rather go too much inflation than have the economy really never or have do much worse during COVID. Had it not been for the Fed and all the spending programs, the economy would have been much, much worse during the pandemic and coming out of the pandemic. So we would be, the recovery though would have been better. So now we're in recovery mode, but I'm just my own view is we had to sacrifice the recovery to get through uh, the downturn. So here we are dealing with inflation, but it is ravaging consumers' wallets. This is why I've been saying I think we already are in a recession. I've been saying this for a few months now. So last quarter GDP was negative. I'll just show you this quarter over here. Just I put this up on the screen here so you could see for yourself. Okay. Whoop. All right. GDP. Okay. Advanced estimate is coming out July 28th. All right. So still have a little bit of time for that. Okay. So end of July, it's coming out. So you should know about that. It's expected to be, some people are saying flat. Some analysts are calling for up a little. Some are calling for down a little. If it's down a little, that means 2 quarters of negative GDP. That puts us into technical definition of a recession. But keep in mind, during the pandemic, we had a recession, but it only lasted like a month, right? So there's no hard rule that says a recession requires 2 consecutive quarters of negative GDP. Recession could be a lot more brief. It could be a lot longer. It doesn't necessarily have to be 2 quarters. But in any event, I do think we're in a recession. It would probably make sense for GDP to be released on a monthly basis as opposed to a quarterly basis. Plus, we give people like me something to talk about even more because I love this stuff. I really do. I find this stuff pretty fascinating. So we'll see how it goes. Is it a real number? The inflation number? Well, yes, it's a real number. The inflation was really hot. But have you noticed this month? It's July 13th. So have you noticed the price of gas is going down at the pump? Yes, I know it's still way up from where it was, but in the last 2 weeks, have you noticed it's been going down? Other prices have been going down. Now, we went over this a few days ago. We went over base metals, agriculture, lumber. Those are down on the year. Oil is coming down a lot. Still up a little bit on the year, but not nearly as much. So oil has been coming down. So you're seeing raw goods, or as we like to say, commodities are going down in price. And there are some food prices going down too. So that's why I think inflation has peaked, and you'll start to see the next couple of months, you'll see inflation coming down a little bit. Um, that'll be helpful for the economy, and that should be helpful for the stock market. We have to separate the economy and the stock market. Sometimes we talk about the economy like it's a stock market. We talk about the stock market sometimes like it's the economy. They are two different things, and one doing poorly does not automatically translate into the other one doing poorly. GDP grows on average, long run rate under 3%, 2% maybe, 1.5%. But the stock market is typically growing long term average about 9.5%. So the stock market actually has always, over the long term, outperformed the stock market, I should say, has outperformed the economy over the long term. I really have no reason to think that's going to change, but everything is cyclical. So we could be in for a lousy stock market for a while. I think we've already had a lousy stock market, but I think a lot of people aren't feeling it unless you're really invested in the most speculative junk there is. The SPACs, the pandemic stocks, the stocks we talk about here all the time that have just gotten absolutely crushed. Bitcoin as well. All right. So the inflation numbers are backward looking. Prices are cooling. That will start to work its way through the system, through manufacturing, through distribution. It'll start. I'm not saying it goes down super fast. It does mean this high inflation figure that came out today. It means maybe it'll take a little longer than we expected, but I'm telling you, it's coming down. Inflation is going to come down. It's already peaked. And that's probably, in my view anyway, why the stock market actually held up pretty good and bounced off its lows on such a horrific inflation figure. We've seen inflation figures that were not as bad as this that have sent the stock market down a lot. Today was pretty tame. Let's take a look at how things did today. All right. So the Dow off 200 points, no big deal. Nasdaq off 17 points. It's a fraction. It's nothing. S&P off 17 points, no big deal. Gold up a drop. Oil rebounded 35 cents a barrel, big whoop. The 10-year yield is still a little under 3, according to this. The VIX was off a little bit. It was really, believe it or not, if you just looked at how the market did today at the end of the day, it was a pretty quiet day. Let's take a look at the bond market. Okay, the yield curve is continuing to be steep or steepening, but the 2-year yield was up. The 10-year yield was down. See that? So 2.939 and the 2-year 3.115. So wow, it's like over 20 basis point difference. So the gap of the 2-year going above the 10-year treasury continues to widen. That's a really strong indicator of a weak economy. Oh yeah, I did say we're in a recession. So it just makes sense. Okay. It makes a lot of sense when I put these factoids together. I'm not trying to take these statistics, put them together in a way that paints a picture. Because there's an old expression: if you torture the data enough, okay, it'll confess to anything. So we could all mix and match data until we get the result we want. So what I'm doing is I'm just looking at the data, period, and then see what the data tells me, not taking the data to see what I could pull from the data. I hope that makes sense. All right. Consumer discretionary had a pretty good day. Consumer staples was flat. Everything else was off a little bit. All right. I want to take a look at a stock. Maybe I'll do this a stock of the day every day. I see something interesting. But Zillow, okay. Zillow closed today at $33 a share. I did an expose on Zillow a while ago, saying that Zillow getting into the home buying and flipping market would be the peak of Zillow and the peak of housing. And more or less I was right. But let's just take a look at the 1-year chart. Okay. Take a look at the 5-year chart. Zillow had reached in early 2021 almost $200 a share. But for a while it traded around 100. And look at it here. Now it's 33. So $200 to $33 to see Zillow do that. That really is just remarkable. And Zillow was like, it was like the Match.com for the housing business, right? For houses. Swipe left, swipe right, right? You tap it, you like it, and contact a realtor to get in touch with that house, to buy that house, to see it, to feel it, to touch it. No, I have not been on Match or Bumble. Haven't haven't tried them. For those of you who don't know me, I am unfortunately recently single, but have not tried a dating app. I'm just relying on good old fashioned introductions from people I know, and I'm very happy to be doing that. That's right, James. Massive drop in Zillow. Do you guys use Zillow in Australia? Is it just a U.S. thing, or is it a you know a global company or developed market company? So that's just another example of the fact that early 2021, the whole pandemic stock complex, the DoorDashes, the Zooms, the Pelotons, they all basically peaked in around February of 2021 and have been deteriorating ever since then. By the way, this is why I always say individual stocks don't always recover, but indexes do. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So there's your tidbit of information today. The day was about inflation. The day to me is also about inflation is a backward looking number, and raw goods have been coming down. Fuel has been coming down. And I think you'll start to see inflation figures come down pretty quickly as the monthly numbers roll off into the future. Next up are earnings. This week, I think on Thursday, we have tomorrow and Thursday, we have big bank earnings, JP Morgan, Bank of America. We have really big companies reporting numbers. We're going to see what they have to say about all of this and what they see for the rest of the year, and that'll help us glean some views into it. By the way, just I'm not really changing anything with my investments. I like what I have. The fact that my stocks are going down recently doesn't change it. Some of my stocks I'm still so far up and it's whatever. I'm not worried about it, and I'm in it for the long term. So I don't really get crazy with the market. The money that I need over the near term is already in cash, so I won't be forced to sell into a down market. When I was younger, there was a point when I had too much in the market, and when I needed cash, I had to sell some stocks just because I had no business putting every penny I had into the stock market because it wasn't prudent personal finance. It sounded good at the time, but now that I'm older and wiser, personal finance does not mean good personal finance does not mean that you invest every single penny you have. Personal finance also means holding back on investing and keeping some money in cash, knowing that there's going to be a low or no return on it. But it's also about liquidity and preservation of capital. And though that's an important part of personal finance. But I'm older, I'm wiser. I don't know if I'm smarter, but definitely experience makes me better. Okay, James says Zillow. No, never heard of it. Okay, Zillow is a big company in the States. Are you being sarcastic with me? But Zillow is a big company in the States, and like every home listing is on Zillow, and it's just a one-stop shop where people go to look at houses. You punch in a zip code, a price range, how many bedrooms, how many bathrooms, do you want a pool, things like that, and it'll start to spit out. It'll create a list of houses according to your preferences. So that's why I said it's like the Match.com or the Bumble.com of houses, right? And the Airbnb is like the Tinder of housing apps. Does that make sense? Okay, I'm getting too into this. Have a great day, guys. I'll see you tomorrow. Thank you very much for joining me. Bye.